There's lots of uncertainty in the market right now, and as a dividend cash flow investor, it can be difficult to understand where do I put my money right now so that it can grow or at least not lose money. Now, I don't time the markets. I can't tell you if the market's going to go down today or tomorrow. I can't tell you if your money's going to drop 25% in value, but what I can tell you is there are companies out there right now with strong balance sheets, strong cash flow that I personally believe, based on all the data and evidence out there, will continue to pay that dividend no matter what's going on in the markets. In this video, guys, I've got not one, not two, but 3, 4, 5, 6 different quality dividend stocks. All of these 6 dividend stocks are trading at a discount compared to their 5-year historical dividend yields. 4 of the 6 dividend stocks have been paying dividends now and increasing them for 25 or more consecutive years. And then as a bonus, I've got 3 additional dividend stocks that maybe based on market conditions have a little bit more risk with them right now, but I still feel like are great dividend buys. Alright guys, let's just jump right into it. I don't want to waste your time. I want to give you extreme amounts of value right from the get-go. So the very first dividend stock we're going to talk about, one that I think is a great value right now, is UGI Corporation. Ticker symbol UGI. Now this is a utility company, and they have 4 distinct businesses here. They have their natural gas and their global liquefied petroleum gas. So within their natural gas segment, they've got natural gas and electric utilities in Pennsylvania and Maryland. They're also the largest natural gas utility in West Virginia. And through UGI Energy Services, they have retail energy marketing, midstream assets, and electricity generation. And then on the flip side, they are also the largest retail propane distributor in the United States. And then they have some overseas business right here. Now, when we think what's going on in the markets, we think volatility, we think energy, but we want to think a little bit differently about utility companies, because as opposed to energy, which definitely has a lot of global ramifications, especially with what's going on with Russia and Ukraine and our own politics here and whether or not we're drilling, putting all that aside, we've got utility companies, and many of them have monopolies in their local areas. I mean, think about it. If you think about where you get your own energy, your gas and electric from, you don't really have much of a choice, do you? So UGI Corporation has been paying dividends now and increasing them for, right here, 35 consecutive years, which makes them a dividend champion. Their current price per share, $38.58. Now, their current yield is 3.73%, and that historically has been around 3.19%, which you're getting about a 14% discount relative to its dividend yield. Now remember, dividend growth rates are critical, not only in regular markets, but especially right now where we have crazy inflation. So as much as possible, we want to combat that with growth rates in the dividend, because if the dividend is growing, it is offsetting some of that inflation cost. Now the most recent year, which was affected by COVID a little bit, was 4.6% growth over the previous year, which is not terrible, but it doesn't quite beat out inflation. However, their 3-year growth rate is 9.9% on average, 7.8% on 5-year, and 7.1% on the 10-year growth rate. These are great dividend growth rates. Now, with respect to dividend safety, we have a payout ratio based on free cash flow. Now, again, as a reminder, I like to use free cash flow for my dividend payout ratio for most types of businesses, because dividends aren't paid with net income. They're paid with cash. So free cash flow is a measure of how much cash the business has available left over after it pays all of its normal expenses and after it has done its required investments into the business, which can be significant for a utility company. So for UGI Corporation, we've got a payout ratio of 52.75%, which is very healthy, which tells me one of 2 things. It tells me the dividend is safe right now. It's only using half of its free cash flow to support the dividend. And then secondly, it tells me this dividend can continue to be paid and raised in the future. Doesn't have a flashy dividend yield at 3.73%. But if you're looking for stability, if you're looking for long-term quality, you gotta go with UGI Corporation. Full disclosure, I don't currently own UGI Corporation in the portfolio, mainly because it's just a little bit low for me on dividend yield, and it's not a dividend stock that I can effectively write covered call options on, which is one of the big priorities I have in my core portfolio. If it had a higher yield, it would definitely make it into my high dividend yield portfolio. For full awareness, that's my specific priorities and growth objectives. All right, next up on the list, we've got another dividend champion, and that is Rowe Price Group, ticker symbol TROE. Now, for those of you that are not aware, T. Rowe Price is an independent investment management firm. They currently have, where is it down here, 1.42 trillion with a T, trillion assets under management, 53 countries that they operate in, and 800 plus investment professionals globally. Now, the big thing that I love about T. Rowe Price Group is the fact that it is a dividend champion, yes, but look at the value you get in buying it right now. Historically, the average 5-year dividend yield for T. Rowe Price Group, 2.70%. And it's currently yielding approximately 4.17%, which is a 35% discount on its historical dividend yield. This equates to massive value. And again, a 36-year track record of paying a dividend, yes, but also increasing that dividend every single year. Currently priced at $115 per share. Look at these growth rates. 17.5% over the most recent year, 15.8% over the 3-year, 15% over the 5-year, and 13% over the previous 10 years. Now, how much impact the current market volatility will have on T. Rowe remains to be seen, except for the fact that it's been really battered down with respect to its stock price. I don't have any concerns right now based on dividend safety, and for that, we look at the dividend payout ratio based on free cash flow, which for T. Rowe Price is at 57.42%. Again, safe right now, likely to grow in the future. Big winner here. I bought into T. Rowe Price about a month ago, and I continue to add as soon as I have more cash available. The goal here for me is to get to 100 shares as quickly as possible so I can start selling covered calls. All right, next up on the list is one that you might not be familiar with, but it's still a quality dividend stock, and that is Harbor Bankshares, ticker symbol BHB. Now, I know you're thinking to yourself, wait a minute, I've never heard of Harbor Bankshares. That's okay. It's a community bank. Harbor Bank and Trust was founded in 1887. They are a community bank and they operate 50 different branches. That's it, 50 branches. They're a parent company of its wholly owned subsidiary Harbor Bank and Trust. 50 locations across Maine, New Hampshire, and Vermont, and they hold $3.6 billion in assets. And it was actually recognized by Newsweek as one of America's best banks. It's got a 19-year streak of paying and raising the dividend, which, just as a reminder, that means that before the financial crisis, Harbor was paying dividends. And through that crisis, they not only paid their dividend, but they raised their dividend every single year. And then COVID happened. And what did Harbor do? They continue to pay and raise their dividend. And despite these market conditions we're currently in, I have little doubt that Harbor, you guessed it, is going to pay their dividend and continue to raise it. Currently priced at $24.85 a share, it's got really strong dividend growth rates at 9.1%, 6.3%, 5.4%, and 6.9%. Current yield, 4.19% against a historical yield over the past 5 years of 3.45%, which is a 17.6% discount. Now, their payout ratio based on the most recent year on free cash flow is 62.28%, which is maybe a slight bit elevated, but still well within a very safe range. For those of you out there looking for stability, safety, owning individual dividend stocks that have a strong history of paying and raising dividends, this is going to be a great fit for you, in my opinion. Now, for me, remember, I have 2 segments. I've got my high yield dividend portfolio and I've got my core dividend portfolio. And this stock doesn't quite fit in between those 2 different strategies. It's not really high yield yet until it crosses over the 5 or 6%, though if it continues to dip in price, I may look to add it there. And it's not one that's popular enough that I can sell covered calls on it for any reasonable value. So it may not fit into my portfolios, but that does not mean it's not a good fit for you. All right, next up here, number 4 on the list is one that I own in my own portfolio. I've continued to recommend it on previous videos, and that is the First of Long Island Corporation, ticker symbol FLIC. Now, this is another community bank located in the state of New York. This company has been paying dividends now for 26 consecutive years and raising the dividend every year, a dividend champion. It's got a current price per share of $17.62 per share. It's got really strong and stable dividend growth rates, 5.3, 6.2, 7.4, and 6.9 over the 1, 3, 5, and 10 years. It's got a historical dividend yield of 3.37%, currently yielding, though, 4.54%, which is a 25.8% discount. And it's got a dividend payout ratio based on free cash flow, 41.03%. Again, for those of you looking for quality, stability, safety, and a strong track record of paying dividends, First of Long Island, FLIC, is going to be a great fit for you. I currently own it in my core dividend portfolio. I'm not able to really sell covered calls on it, but I still own it. I still am holding it. I'm just not adding new money to it right now because it doesn't fit into my current strategy. But like I said, stability, safety, quality, great options for the average Joe investor. All right, number 5 on the list here is one that I'm sure you've heard of, and that is the 3M company. MMM is the ticker symbol. 3M offers a wide array of different products that are used by many different industries, from scotch tape to duct tape to different tools and equipment. There's a vast array of different products here that are used by so many different industries. Now, what I love most about 3M company is their dividend track record. 64 years of paying and raising their dividend every single year. 64 years. Now, the most recent year of dividend growth rate only grew 0.7%, which is not great in my opinion. The 3-year growth rate is 2.4, and then historically the 5 and 10 year are at 5.7 and 10.2. Now, their historical 5-year yield is 3.24%. And you can currently get it for 4.58% on the dividend yield, which is a nearly 30% discount. And from a dividend safety perspective, their payout ratio for the previous year based on free cash flow is only 61%. From a battling inflation perspective, 3M is not necessarily the best bet based on their current dividend growth rates, but again, if we're looking for, during these volatile markets, stability and safety, you can't get much better than 3M. 3M is not currently in my portfolio and not one that I'm currently targeting based on my 2 objectives, again, high yield and with respect to a core portfolio that I can also write covered calls on. However, it is one that's probably going to be a great fit for most investors. All right, last dividend stock here on my list is Prudential Financial. Ticker symbol PRU. It's in the financial sector and it's an insurance company. Prudential is both an investment management firm and also an insurance company. And an insurance company is one of the biggest beneficiaries of current rising interest rates. We know that the Fed is actively trying to combat inflation, and while rising interest rates hurt certain industries, they also help others. Insurance companies have to invest part of their life insurance premium that they receive into stable assets. And if stable assets have higher rates, then they get higher returns on that money. Prudential has been paying dividends now for 14 consecutive years and raising that dividend, which makes it a dividend contender. Current price per share, $92.49 per share. Their 1-year growth rate is 4.5%, but their historical 3, 5, and 10-year growth rates are in the green, 7.9, 10.3, and 12.4%. Now, their historical 5-year dividend yield is about 4.76%, and you can get it at an 8% discount right now at 5.19%. Now, what I love about Prudential Financial is their payout ratio based on free cash flow at only 6.16%. That tells me they have so much free cash flow that they have so much to support the dividend and continue to grow the dividend in the future. Now, I've also got 3 additional dividend stocks here that I think might be great options despite maybe a little bit more risk in the current market environment we're in. So let's dive into those here. We'll just look at all 3 of them right now. We've got Best Buy, Altria Group, and Arbor Realty Trust. Let's go through these one by one. Arbor Realty Trust has got a great dividend yield right now, 11.61%. And they have historical dividend growth rates that are very strong over the 1, 3, and 5 years, 12.7, 10.9, and 17.3. And their current price is $13 per share. It's been paying dividends now for 10 consecutive years. Now, the risk with Arbor Realty Trust is it is what's called, here, let me just open this up here, it's a mortgage real estate investment trust, which means that they're similar to a REIT, a real estate investment trust, but instead they actually have a portfolio of mortgages. They're a lender. Now, with mortgage REITs, they are one of the hardest hit based on the current market environment. Rising interest rates reduce the amount of profit that they can make, the spread on how much they can borrow money for versus then lend it out. That makes it more difficult to make a profit, and as a result, it could be subject to a dividend cut in the future. We just don't know. This is one I own in my own portfolio, but I'm not actively adding new money to it. I don't want it to become too much a part of my portfolio in case it does have a dividend cut in the future. It's one that you could add at least a portion to your portfolio. It may never cut their dividend, but it could be, based on the rising rate environment, subject to a dividend cut in the future. Then we've got Altria Group right here. They're in the tobacco industry. They're big on cigarettes and other types of smoking products. Now, the big issue here is the Biden administration moving to remove nearly all nicotine from cigarettes. So they're trying to reduce the amount of nicotine that are available in products, factoring in the dual ban of their e-cigarettes combined with the nicotine crackdown from the Biden administration is not a great environment for cigarette makers and nicotine products. However, it doesn't mean that Altria is not a good option right now. Investing in Altria might not be your cup of tea, especially based on the type of products that they make. However, it's trading at a discount discount right now, it could be a great option for you. Carries a little bit of risk. And then lastly, we got Best Buy here. This is one that I bought into recently, and I included it as just a little bit risky just because it's in retail, right? And we know that big box stores generally are on their way out or struggling to make a profit in this e-commerce world we live in now. However, it does have a 19-year history of paying a dividend and raising their dividend. It's got really, really strong dividend growth rates, as you can see here on the 1, 3, 5, and 10-year growth rates. And their current yield is significantly higher than what you've seen historically. Over the past 5 years, they're at 2.73%, and you can currently get it for 4.94%, which is a 44% discount. That's why I like Best Buy right now. That's why it's in my own portfolio, along with Altria and Arbor Realty. Hopefully you found some value from this video, guys. Make sure to leave your 2 cents down in the comments below. I respond to all comments received on the day I post a video, even if I don't quite get to those comments until the next day or 2 days after that. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.